Hello, we are Group 18 and we'll be presenting on Dick's Sporting Goods acquiring Academy Sports and Outdoors. So Dick's Sporting Goods is a Fortune 500 company and is also America's largest sporting goods retail company with a market cap of $12.1 billion. It has approximately 858 stores and 50,000 employees. On the other hand, Academy Sports and Outdoors is also an American sporting goods chain with a market cap of $4.6 billion. It has approximately 268 stores and 17,000 employees. So the deal size of this merger is $6.69 billion. We believe this amount should be easy for the acquirer, Dick's Sporting Goods, to arrange, given the reputation and size of the company. To raise this capital, we have proposed Dick's Sporting Goods to raise $3.2 billion through bond issuance and the other $3.12 billion by issuing additional 21.5 million common shares at the current market price, which is 145.05 per share. So according to our projection, ASO is acquired on discount at 76.5 per share, which is at a premium of 26.4% based on the current market price of 60.51 per share. Yet, given the estimation, the target company might be a bit reluctant to accept the deal, as their growth potential standalone might generate higher returns as they are still in the early stage of expansion.
We believe that this acquisition can generate several synergies. First, for operating synergies, the merger of these two companies can generate economies of scale. For example, ASO can use the existing logistics and distribution center of DKS, which greatly reduces the preparation cost of opening new stores, and they can strengthen their bargaining power. And merger will bring new product line. What's more, the two companies can integrate their resources. For example, DKS has developed an e-commerce business platform which ASO can use to offer more service to its customers. For management synergies, the merger of two companies can save overhead costs. DKS has a more mature management system and ASO can improve management efficiency. For financial synergy, where the company's capital expense, the risk of bankruptcy, and the cost rate of raising business will reduce. But we anticipate potential risks. Risk of these economies of scale from the disagreement of management style and culture. Second, ASO continue to expand after acquisition could lead to cannibalism. Then more employee and processes in earlier post acquisition stage could impede the efficiency and innovation. As far as potential risks are concerned, we think most of them are manageable.
We propose Dick's finance this acquisition by raising $3.2 billion via bond issuance and another 3.1 by given the current price, which is $145 per share, which required to issue additional 22 common share, which account for additional 14% more current fully diluted share outstanding. And the range of additional share issuance is varying from 13% to 35% of the current fully diluted share outstanding. One major drawback of the equity financing is dilution due to the price plunge unexpectedly, and more share needed to be issued to finish the financing. To visualize the effect, we done scenario analysis and the detail has been shown on the screen. To further dive in, according to our projection, even the price falling to the lowest point in 52 weeks, and acquisition still won't cause any dilution to shareholders' value, which we use matrix is the EPS, the earning per share, which about $6.85 per share at this moment. The scenario analysis further indicates even without synergy, there is a sufficient amount of buffer for the post-acquisition synergy creation and strategic adjustment. Next, we project, given the current offer, which is 26.5 premium, which given the 76.5 per share, this acquisition will bring 40% accretion effect to current shareholder of DIX. If we account for projected synergy, this effect can be doubled.
So for our discounted cash flow analysis, we basically take the future cash flows of a company and we discount it according to a calculated discount rate. Now, the discount rate that we used was actually the weighted average cost of capital, which we calculated for DKS, our acquirer. So our right calculation is visible in the table in front. We basically calculated it according to the formula cost of debt adjusted for the tax rate plus the cost of equity. So in the table, you can see that we first calculated the debt ratio and the equity ratio for DKS. And then based on that, we got a cost of debt adjusted for tax. And then for cost of equity, we used CAPM, in which we had the beta, the market return, and the risk-free rate, which basically gave us a total WACC of 13.94%. Now, this value, we compared it to the industry average, and the industry average was around 12.7%. So for our DCF calculations, we basically used an average of these two values, and we sensitized these values accordingly. So based on these values, we also had the terminal perpetuity growth rate and the EBITDA multiples, which are calculated in our Excel file. And the sensitized values show basically the total equity value and the share price. So the fair value of the company and the fair share price of the company. And these sensitized tables show that there is deep value that can be found within ASO. So just based on a DCF analysis, it means that our acquirer, DKS, should go forward with the acquisition as the company, according to these calculations, is more valuable than what it's currently priced at.
Our standalone projection of ASO's growth suggests that even without making any modifications or any changes in their operations or management style, we can still provide value to DIX shareholders. Also, we believe that there is enough buffer to equalize the potential friction between the two firms merging into a single unit. However, there is still a little room for negotiation on the premium with ASO's team, and we also believe that there is still a few chances of rejection of the mergers, and also DIX stock volatility may slightly impact the value. However, the effect would be very less. But overall, we suggest an early acquisition would definitely bring value to DIX shareholders, and also it would help in eliminating any competition in the future. To sum it up all, we believe that the acquisition would be beneficial to DIX and because of the synergies, and also 26.22% of a premium is a good start off. But the most important, the crucial part that has to be paid attention is to align the strategies and positions post acquisition to maximize the synergy.